Welcome back to U.S. Farm Report this weekend. As promised, we have Joe Vaclavic as well as Peter Meyer joining us. All right, Joe, looking at these reports, these WASDE reports for July from USDA. USDA not really touching the new crop forecast for corn or soybeans. Yield left at 181 bushels per acre. Production forecast at 15.1 billion. Soybean yield pegged at 52 bushels per acre. No surprise there, but we did see some changes to ending stocks for old crop corn. Joe, what were the biggest surprises for you out of this report?
USDA posted substantial increases to its old crop demand forecast, which is something that came totally out of nowhere. The June 1st stocks numbers, which we got on June 28th, would have indicated that the old crop carryout number was going to go up, and it actually went down. So this was, as a matter of fact, it was about the most friendly report you possibly could have received from USDA today. They added hundreds of millions of bushels of demand. A lot of it was old crop. There was a little bit of it in new crop. I think it's overall kind of, relative to expectations, it's a friendly deal because that demand that they added for old crop, that's real demand. Everything on the new crop balance sheet, the yield, the acres, the demand, that's all smoke and mirrors. That marketing year hasn't started yet. But the old crop stuff is real, and you could take it to the bank. The reaction in the market to this point, the market's still trading as we're taping here, but the reaction was poor and could have been better. But make no mistake, it was friendly relative to what it could have been.
Yeah, to follow up on that, USDA raising both exports and feed usage for old crop by 75 million bushels, and then feed usage another 75 million for new crop. So those were some changes that were made. But Pete, as Joe mentioned, this was about as friendly of a report as we could get, yet the markets aren't acting that way.
Yeah, I can accept the feed number up 75, the export number up 75, and corn to me is very questionable. But I think, the markets, as Joe suggests, this is probably the best report we could have gotten if you're looking for any upside. But one of the more telling things to me is that I always look at year-on-year supply versus demand, especially in corn. There's a very high correlation between changes in supply and changes in demand, not production, total supply. Supply now from the 23-24 to 24-25 year is up 270 million bushels. Demand is up 50. This is very telling to me because typically during the year, they will adjust that by 50%. And we did a 25-year study where actually the correlation is probably closer to 85%. But the fact that they did not use their 50% rule and increase demand by 135 and only increase it by 50 suggests to me there's very little confidence in their demand numbers. Me personally, I don't trust the demand numbers at all. I would have thought that they would have increased the demand, but when I talked to our clients, I didn't know where they were going to increase the demand. That goes back to that I don't trust the demand side of it. And on the soybean side, carry out was 460. Carry out was 435. I have 460 is our number. And the reason for that is that I have exports at 1.8 and they have exports at 1.825. Again, we did get a sale of soybeans this week to China, but you want to look at the book doesn't look very good to me.
Well, and you look at these adjustments to the balance sheet, but the fact of the matter is, Joe, when you look at the amount of grain being stored on farm right now, corn, the highest level since the 1980s, what does that mean for price action moving forward over the next few months?
The general narrative among traders and analysts is that the market cannot rally in a material fashion until that stuff is sold, right? I don't know if that has to be the case necessarily. If you see demand enter the marketplace in a material fashion, and I think it's got to be on exports, I think that's where it has to come from. I think that's what could move the needle real quickly. If somebody, somebody along those lines comes in and decides that they really want to buy U.S. corn, we're competitive on the export market. Things could change quickly. They could. And the old crop carryout situation, it's not 2 billion bushels. It's going to be closer to 1.9 to 12.6% stocks to use ratios with being projected for old crop. That's not the most bearish thing in the world from current price levels. I'd probably argue, if anything, it's friendly from current price levels. The new crop situation, yeah, it's probably bearish, but the new crop marketing year hasn't started yet. So, I still think overall this report today, it was a friendly item. Is the on-farm stocks thing, is that friendly? No. But we got some good news today.
Okay, Pete. So as you look at the fund positions, you look at the amount of corn being stored and grain in general being stored on farm right now. What is the battle right now between the funds and the amount of grain farmers are holding on to?
Well, the funds really don't have a fundamental view. To be honest with you, they are still trading the path of least resistance, and the farmers are holding on for higher prices. So let's say for argument's sakes, I agree with Joe, and this is a friendly report. How friendly can it be? 4.25, 4.30. Is that going to get the corn out of the farmer's hands? I don't know. So, I mean, the funds will keep selling it, or they'll stay short until such time that the farmers capitulate. Funds are not stupid. They saw that 3 billion bushels. They know what's going on.
Well, when you look at some of the carry-out changes, you mentioned soybeans. We're looking at new crop corn, 2 billion bushels, wheat, 856 million bushels. I mean, there were some changes there, but still we have this debate about yield. So when could USDA possibly adjust yield? Will it be to the upside? Will it be to the downside? We're going to ask Pete and Joe that next.